good afternoon, everyone, and thank you very much for attending this webinar where, yes, we will try to share our view on the economic impact of this crisis, and well, also we'll try to answer to all your questions about the impact in Europe because it will be the focus of this event, but also well, every question that you could have about this topic on this very fast-moving situation with very uncertain times. But so just to start, here is the content of the webinar of today. First, we will discuss the evolution of the pandemic, and we'll try to show you our scenario and why we think that. Then the first leading indicators of the economic impact in Europe, and you will see it's an hopeful impact. Then our global economic scenario with the business insolvency forecast too. And we'll see that this time maybe it's a difference with comparing to 2009. It's that the central banks and the government are acting fast and very strongly. And then just to finish the presentation, we'll discuss the medium and the long-term consequences of the pandemic. And we will see that this crisis, this shock that is supposed to be temporary, will probably exacerbate the existing vulnerabilities of the European economies. But so just to start, as you all know, well, at the beginning, in January, February, it was, let's say, a Chinese topic. At the beginning, we were just registering cases and deaths in China. So at the beginning for us, the huge question was how our countries will be affected by the slowdown in the Chinese economy. And so it was basically a supply chain issues with global actors that were affected by the suspension of the production in China. But at the beginning, the European countries were not the most affected because, as you know, the European economies are very integrated into the European Union, so they're not the most affected countries by the Chinese slowdown. But then, and you can see it in the second chart, we saw and we registered, of course, new cases now in Europe, and so it was a totally different issue now because we registered cases in Italy. Then you can see a week after in Spain, then in France, in the UK, and so on. And so, well, we moved from supply chain issues to global demand shock, global supply chain shock, and also a huge uncertainty shock in the markets that led to a fall down in the stock markets. And so here we can understand how it worked and how we moved from a Chinese epidemic to a global pandemic. And so now, of course, one of the question and one of the most important factor will be how long will the lockdown last. And so just to try to find out how long it will last, we are trying first to understand how a pandemic works. And well, you can see here the propagation rate that depends on the number of the daily contacts, of the probability of the contagion, and the length of the disease. And so the only variable on which the government can have an impact is the number of daily contacts. And this is why all the governments all over the world decided to implement some containment measures, because otherwise you can see that the RO, the propagation rate of the coronavirus is around 3. It means that each people that carrying the virus will infect 3 other people. So it's exponential, and so at the end, in around 2 months, you will have all the population, for instance, in France, who will be affected. So, of course, it's not acceptable, and this is why the government decided to implement some containment measure to lower this propagation rate under 1, so to stem the pandemic. Then, of course, well, for instance, in Norway, according to the health minister, they reached the R0 of 0.7. It means that then we have a peak and then we have a slowdown in new cases. And so the pandemic is under control. Then, of course, and it will be the matter here is that when you lift the lockdown and containment measures, the number of daily contacts increase, and then you can have a second wave because, of course, you will have a higher R0, higher propagation rate. And this is all the variables that all the governments will try to monitor to understand how long the lockdown is due to last. But you can see that with a R0 lower than 1, you can, let's say, stem the pandemic during after 1 month and a half or 2 months. And this is why it's our scenario of a lockdown that will last 1 month and a half or 2 months, and then a very gradual reopening of the economy. And so you can, the other point that is interesting for us, because Europe is, let's say, the second wave of the coronavirus, because the first cases appeared in Asia, so in China and then in South Korea. Of course, it's not so easy to compare the two regions because we don't have the same testing policy. As you can see in the left chart, in South Korea, the number of tests per million people is way higher. So, of course, they had different strategies. But anyway, we can see that, for instance, in China, after 2 months of lockdown, more or less, many businesses resumed work in China. During the month of March, you can see that from 15 to 20% of the businesses that stopped working resumed work. So it means that as it's a temporary shock, where the government stopped totally and tried to freeze the economy during this lockdown measure time, then the economy is supposed to recover. So we could have a U recovery or a V-shaped recovery. You can see in China, this is the point. But before talking about and discussing the recovering phase, of course, we have to talk about the shock that our economies in Europe are currently experiencing. And you can see here the first business survey. So for March, we are talking about the PMIs of market, and where, well, 50 is the no change threshold. It means that when we are under 50, we have a contraction of the activity, and when we are above 50, we have an expansion of activity. And you can see that, of course, in March, all the European economies registered a decline in activity in the manufacturing sector, with, it's not surprising, Italy being the most affected. You can see that the Italian PMI is at 40, when the others are more around 45. And it's due to the fact that Italy was the first country affected in Europe. And of course, it's worth mentioning that in all the other countries, as these surveys were carried out in early March, it means that, of course, we can expect a further decrease in April. And if we look at the services PMI, we can see that they point to a collapse, because, well, we are registering now the lowest level ever recorded since the survey is carried on, and this survey was created in 1998. So it means that it's way stronger, like the impact is way stronger than during the previous financial crisis. And we can see that, and it's important to note that Italy, you can see they reached 17, and it means that probably for France, Germany, Spain, and the UK, we will reach also this point in April. And so it's a huge shock on the services, because we can see that this shock is, as I said, a supply chain shock, because, of course, all the companies have to close, all the non-essential activities have to close, let's say all the shops have to close, and many other companies cannot keep on working, cannot continue their processes, because many people are locked at home, or because they fell ill, or because of the school closures, and so they have to care after their children. So it means that it's a supply chain issue, but also, and this is the second part of this shock, it's a demand depressed shock. And you can see it with the first estimate in France, because the good point, if we can say that it's a good point of this economic disruptions, is that, well, basically all the European economies are going through the same shock. So from some estimate, for instance, in France, we can deduce the same, basically, estimate also in the UK, in Switzerland, in Belgium, as all the countries implemented the same measures. And so we can see here that according to the National Statistics Office in France, that the consumption fell by 35% during the first week of the lockdown. And well, it's explained by, of course, industrial goods. We can see minus 60%, but also in construction, as construction is one of the most affected sectors, with a loss in activity of 89%, and so a change in consumption of 90%. Also, the services, all the services that are non-housing services, because of course many people keep on paying their rent bills, but all the other services are sharply affected, because on the one hand, many non-essential shops had to close, like for instance the clothing shop or the electronic shop, and despite they can keep on selling online, many people won't consume and won't spend the same way online that going into a shop. Then you also have the confidence which fell down in all the countries, because of course the expectations of the households are deteriorated a lot, because of course they don't know in these uncertain times how long will the lockdown last, and also because they are expecting lower incomes during the next months, because despite, and we will talk about it, despite many governments are paying now the wages to the temporary laid off people, they only pay, for instance, in France 84%, in the UK 80%, and in Switzerland around 70%. So it means that it's a loss of 15, 20, 30% of income, and it's huge. And so at the end we have less consumption. So it's a shock in the supply chain, but also in the demand side. So this is why the shock is so important, and we never registered such a magnitude shock. And here you can see our scenario. So with all these elements, with the pandemic evolution, and also the first data about the impact, you can see the scenario that we built. So first, according to our baseline scenario, in the Q2, we should have, like, say, a gradual reopening by May, probably. It will depend on the countries, of course, because the first countries that implemented containment measures, as Italy or Spain, are due to reopen very gradually, and this is the very important point, very gradually, at the end of April or at the beginning of March. Then in France, the president will talk on Monday, but probably, according to our scenario, the containment measure will be progressively lifted from maybe mid-May or early May, and then in the UK it will probably be later. But anyway, all these gradual reopening measures will happen in May, and so it means that then we should have a gradual reopening in the Q3 and in the Q4, but with businesses and consumers remaining very cautious, because of course we'll always have the threat, we still have the threat of a second wave. You know, according to our baseline scenario, we won't have a second wave, but according to you can see our risk scenario. we could have a second wave. We cannot rule out the second wave of the pandemic that will lead to additional quarantine periods and containment measures that will be absolutely dramatic for the global economy. And you can see here the impact of these scenarios in the GDP growth forecast. You can see here that we have huge slumps in GDP growth in Q1 to begin, and then in Q2. And then, as it will only be a gradual reopening, we'll have a slow rebound in Q3 and in Q4. Of course, let's say a recovery in Q3 seems to be obvious because the base effect in the Q2 will be very low. But it doesn't mean that in Q3, because we are forecasting a rebound, the activity will be 100% as it was before. And so with this scenario and this shock in the Q2 and in the Q1, you have here our forecast for the whole year. And you can see that the forecasts are very negative. With, for instance, in the Eurozone, 6.2% in decline of the GDP. In France, minus 6.8%. In the UK, minus 6.1%. And also, for instance, in Belgium, minus 6.4%. And if we compare our estimate to, for instance, the National Bank of Belgium, yesterday, they forecast a minus 8%. So we are being not too pessimistic, let's say. And well, Switzerland, as they are all going through the same measures, in Switzerland, we also expect a GDP growth negative by 5.8%. So we are talking about a huge shock, even in the Eurozone, even worse than in 2009. In the US, you can see that we also forecast a minus 2.9%. So it's a major shock. And despite it's supposed to be temporary, and we should have a rebound in Q3 and in Q4, and then in 2021 we should, if there is not second wave, and we'll find some vaccine or some cure, it will mean that we'll have a sharp rebound. But for this year, it will be a huge impact, and so GDP growth very negative. And if we look now at the global GDP estimates, you can see here that, well, we forecast a minus 1.3% of GDP growth, and it's the sharpest downturn since the global credit crisis in 2009, where we recorded a minus 1.7%. So it's a huge decline in GDP growth, and of course, it will lead to higher business insolvencies. And you can see here that we forecast at the worldwide level plus 25%. We can compare it, as you can see here, with the numbers and with the figures during the previous global credit crisis. In the Eurozone, we should also experience a plus 16% or 18%, and in the US also a sharp increase. But now, if we move to the next slide, and we'll see country by country our forecast on insolvencies. And you can see here that, of course, the European countries are the most affected, and well, it's logical because they are also the most affected in terms of GDP growth, but also that, for instance, the US will register a huge increase in insolvencies. And maybe just to anticipate some of the questions, the UK is one of the highest insolvency forecast growth with plus 33%, and it's way higher than, for instance, countries that are supposed to be more affected by the pandemic, like Italy and Spain or France. For instance, also France will register, according to us, a decrease in GDP growth by 6.8%, because in the UK, for instance, but also in Netherlands, the insolvencies are way more sensitive to activity than, for instance, in France or in Belgium. And just some figures so you understand this point. During all the previous times when the activity contracted in the UK, for instance, in 1991, we had a plus 45% in insolvencies. During the previous crisis, we had a plus 52% in insolvencies in the UK, while in France we had and in Belgium only plus 25, 23%. So this time we also expect the insolvency to increase sharper in the UK than in the rest of the European countries. And it's basically attributable to the fact that in the UK, like in the rest of the economy, let's say, we have a more liberal, more flexible approach. And then, for instance, in the UK, the insolvency procedure is way cheaper and faster than in France, for instance, according to the doing business data of this year, and it's also the case in Netherlands, for instance. In Europe, in Netherlands, and in the UK, these are the two cheapest and fastest insolvency procedures, and this is why they are so sensitive to activity. But this time, let's say that the governments and the central banks reacted very fast and very strongly. For instance, they all decided to implement strong, and well, it depends actually on their fiscal space. You can see it in the second chart, but they all decided to implement a huge fiscal impulse since the very beginning of the crisis, because they had to, for instance, to pay the wage of the temporary laid-off workers and also self-employed workers. And also, they all decided to defer the payment tax because, of course, what all governments try to do is to freeze the economy. As all the companies won't have any revenue, they just try to defer all the payments, so to allow all the companies to after the lockdown and the containment measures, to return and to resume work and just to return to their activity. Because, of course, when you cut all the revenues of the companies, you have the risk that they all enter into insolvency procedures, or that the people go to enter in and get unemployed. And so at the end, you will jeopardize the recovering phase, because you have so many unemployed people who won't be able to spend, and also because all the companies will try to hire new people, so it will take time and it will jeopardize the economy. This is why what all the governments are trying to do is to freeze the economy, to support the households and the companies, and then just to try to find out how we'll make the economy recover then. But of course, the matter is that so the fiscal stimulus will have a cost, and then after this fiscal stimulus, they also announced, for instance, huge amounts of state-backed loans to the corporate, because of course what they fear is a credit crunch, that the banks and the insurers, but more the banks or all the financial institutions, doesn't lend anymore to the companies. And so what they try to do is to substitute the banks and to take all the risks, all the risk. Because what we have to understand here is that, on the contrary to the crisis, the previous crisis, this time it's not a financial crisis, so it's not, let's say, the fault of the financial system. This health crisis led the government to decide to freeze the economy and to close all the businesses. So it's, let's say, normal that the government try to substitute, because, let's say, it's their fault, despite it was probably the most reasonable decision. They had now to back all the financial institutions and to take the risk. But of course, not all the companies will be able to repay these loans, and so it will also increase a little bit more this public debt that you can see in the left chart. And also to understand how we made our forecast of public debt for next year, we also take into account the loss in revenue, because less activity means less revenue, and also as the GDP will fall by 6, 7, or 8% in all these countries, it means that the public debt on GDP ratio will increase very sharply. And you can see here that, well, for Germany, it's not a problem because they deleverage a lot during the recovering phase, but you can see that in countries like Spain, Italy, and France, but more Italy, of course, and we will talk about it later. It can be a huge problem, and the market have some fears, let's say, about the Italian debt, and if the central bank, the ECB, will support the Italian government or not. And this is the second point, because not only the governments decided to act fast and strongly, but also the central banks. And you can see that they acted in at least two stages. Here you can see that, for instance, at the beginning, the Bank of England decided to make an emergency interest rate cut, and the ECB quite early decided to announce additional net asset purchases. But the matter is that according to the market, it was not sufficient. They had, and we'll see that in the next chart, they had important fears that finally it won't be sufficient to really support the Italian government, for instance, and all the most fragile governments. Because, of course, the magnitude of the fiscal stimulus signify that at the end you have a higher public debt and so on. And this is why at the end, 1 week later, let's say to calm down the markets, the ECB announced a new pandemic emergency purchase program, way more substantial. And apart from the amount, the important point was that there was no monthly spending limit. It was a way more flexible purchase program, and also that they had the flexibility to deviate from the benchmark allocation and from, let's say, the rule of 1/3 limit of a country debt. So the ECB can buy more debt from, for instance, the Greek government or the Italian government if needed. This is why now it was the second phase, the phase of the whatever it takes to calm the markets and to show the market that the ECB will support all the governments during this pandemic crisis. And well, we can see that also the Bank of England announced further interest rates cut, and also that they will buy, and it's very important now that in this crisis, all the central banks are buying also corporate bonds, not only government bonds, because they understand that, of course, as the governments are backing many corporate loans, they also have to back the corporate loans, because the main risk is that the corporate is a corporate credit crunch. And as I said, so the last intervention of the ECB was because of the peak that you can see at the end of the chart, when, so after the first meeting in the 12th of March, let's say the European central bank governor, Madame Lagarde, said that, well, it was not the matter of the central bank, the spread in Italy. And you can see that, well, at this moment, everyone in the market was fearing that at the end, the central bank would not support Italy during this crisis. And so we had a peak in the spread. Then, after the measures announced, so in March 18, we had a calm phase now, and you can see that it's not anymore, let's say, the main risk, but we can see that the Italian debt is very sensitive, and the bond yield in Italy is very sensitive to the political developments that you can see in 2018, and also to this risk. And one of the main issues is that in Italy, the government bonds are mostly held by the Italian banks. So we have a risk, of course, on the Italian banks, and that the companies, and even more the smallest companies in Italy, are very dependent on the bank financing. So it means that at the end, this peaks on the sovereign bond yield in Italy jeopardize the banks, but also the corporate there. So it's a very important topic, and of course, it will be one of the main risks, let's say, at the end of this temporary health crisis. But the governments are not the only one who doesn't, let's say, take the chance to and take the opportunity to deleverage during the recovering phase. You can see here that, for instance, some companies in France, for instance, kept on increasing their indebtedness to invest. So, of course, during this time and when the financial conditions were quite favorable, it was something quite positive. But at the end, you can see that now that we have a downturn in the economic conditions, it will let them way less space and way less room for maneuver than before. And of course, apart from that, we'll have the very important question of the zombie companies. You can see here that the zombie companies are companies which are highly indebted and also that are not profitable. And because and thanks to these very favorable financing conditions, at the end, all these companies are surviving. But now that we have a crash in the global economy, probably all these companies are very likely to go bankrupt. So let's say that we can see, for instance, in France, that even during this recovering phase, when we had 6, 7, 8 years of constant GDP growth, we had a constant increase in share of zombie companies with 5%. And we don't have, unfortunately, data, for instance, for the UK. But anyway, the share of zombie companies is probably the same than in France or at the best in Germany. But so we are talking about 5% maybe of zombie companies. So it's this proportion of companies that are very likely to go bankrupt, and that will be the first to go bankrupt during this crisis. And of course, as all the European economies are so interdependent, at the end, if some companies from these countries go bankrupt, then all the supply chains, all the European supply chains will be disrupted. And just to finish this presentation, what will be and what could be the long-term consequences for the businesses? As I said, well, the first element is the faster Japanization of the world economy with higher corporate and public debt, and also the fact that the central banks has now to support the private sector because they have to buy corporate bonds, to buy also more and more government bonds because, of course, the central banks buy corporate bonds from then the government-backed loans. And also, well, then the other question will be in the second phase in the emerging markets because, of course, we have this problem of higher public debt and corporate debt in European economies, but with, let's say, a central bank that is very credible and which inflation expectations are credible. Now, the great question will be if in emerging markets, the countries and the governments and the central banks will be able to also take the risk and to finance their investment and their package without, for instance, generating more and more inflation. So there is a huge risk of debt crisis in some emerging countries, and it will be probably the next risk to monitor. And if we look maybe even in a longer term, regarding the future of globalization, of course, now many people are saying, well, we will now relocate activity and production in advanced countries and so on. According to us, we won't have such a change, such a shift away from producing abroad, but probably will have different structure, let's say, on the global chain, with more diversified suppliers, because of course, and it was made in the first phase, of the pandemic crisis, where everyone realized that we are hugely dependent on China in some sectors, for instance, in ICT, in textile, or in automotive. But the usual drivers will keep on be at play, as it's written in the slides: penetrating a fast rising market, producing at lower cost, and also accessing commodities. So we don't think that all the advanced countries will repatriate the production in Europe, for instance. Thank you very much for your attention.